Today, I am going to show you investing in a time of war. Before the start of the video, make sure to leave a like, and if you want to see more content, subscribe to the channel. Let's get started. Off the back of the current situation in Ukraine, many of my clients have been asking me what this means for their investment and pension portfolios. Irrespective of the size and scope of the conflict, any declaration of war has global repercussions. Instability in one area of the world will result in a ripple effect, affecting other areas of the world regardless of the countries involved. Yes, this is likely to affect your investments and your pensions, but the key takeaway is that you should not worry. If you are panicking, please reach out to me and we can have a conversation about it. There are even areas of opportunity in war times, and stocks in certain sectors have even bucked the trend and outperformed. In this article, I will discuss investing in war times, including the current conflict in Ukraine, and the impact that this has on the stock market performance and the wider economy. The current conflict in Ukraine. In the case of the current conflict between Russia and Ukraine, the heavy sanctions inflicted on Russia already have and will continue to heavily affect the global economy. The sanctions are amongst the harshest sanctions ever imposed on a country and include preventing the Russian government from accessing up to $600 billion in foreign cash reserves, which they hold in foreign banks around the world, banning Russia from SWIFT, thus preventing Russians from using various credit and debit cards to make payments, and freezing of the assets of some Russian individuals around the world, ranging from bank accounts, property, and even private yachts. Various multinational companies have also ceased or reduced their operations in Russia, at least temporarily. For example, Apple has closed their Russian stores. Shell and BP have sold their stakes or abandoned their Russian operations. And a magnitude of aviation companies such as British Airways, Lufthansa, and Boeing have either halted their flights to Russia. Note that there have also been significant alterations in the accessibility of international airspace, or in Boeing's case, suspended parts, maintenance, and technical support for Russian airlines. The conflict does not solely impact the Russian economy. A large number of countries throughout the world export products to Russia. If this is no longer possible, then they will see a reduction in profits, which will then go on to affect their balance sheet. Furthermore, many countries in the world import products from Russia. The key product in this case is oil, a vital energy source. Although the supply of oil has not yet been cut, we have already seen a rise in petrol prices in many countries such as the UK. Other popular Russian products such as vodka are likely to be hit. Due to the decrease in supply, we are likely to see both shortages and a rise in the price of Russian products such as vodka. However, it is very difficult to predict exactly what will happen. For this reason, when making personal finance-related decisions, it is recommended that you engage in a professional discussion with a professional financial advisor. In times of war, in particular, it is recommended that people seek the advice of an expert to help them manage their portfolios. Previous wars and their impact on stock market performance. We must consider previous wars and the impact that they had on the stock market. Some civil wars and internal conflicts, such as those in Sierra Leone, 1991 through 2002, and the Central African Republic in 2013, caused several disturbances in those countries' economies. However, from a global perspective, these wars did not cause disturbances in the stock market of first world nations such as the USA. On the other hand, large-scale wars such as World War I and II did affect the U.S. market, even before the U.S. entered the conflict. Global markets in the past operated very differently from how they operate today. For example, before World War I, every country operated independently, and the countries that operated in global trade were seen as at the gold standard level. London was the world's financial capital and used in this way when a financial center was necessary. However, the requirements and responsibilities were very different when compared to nowadays. At the close of World War II, significant changes were made to the global financial system with increased interdependence between countries. The World Bank and the IMF, International Monetary Fund, were created. And from then on, stocks reacted very differently from World War I and World War II when conflicts arose. It's also important to consider the popularity of the war on the home front and the amount of time in which the war goes on for. For example, the Vietnam War and the Gulf War both saw very different stock market outcomes in the USA due to the difference in popularity of the wars amongst Americans. Furthermore, the Afghanistan War lasted almost 20 years. In these 20 years, the market saw both highs and lows. Ultimately, the longer a war goes on, the less reactive a market is to its influence. A war may start to be seen as a business-as-usual type of operation. Thanks for watching, guys. If you enjoyed this video, smash that like button, subscribe to the channel, and turn on post notifications to see more of our future videos. With that said, keep enjoying our videos, and I'll see you in the next video.